2022 has been a very turbulent year so far. More than $7 trillion has been wiped out from the stock market this year alone. And thus the S&P 500 index is approaching a bear market as the index is down nearly 18% since the end of December. And the Nasdaq index, with its tech-heavy focus, too lost more in market value than in any of its previous major crashes and is down more than 25%. Now, one would think that it is fairly easy to understand that the current sell-off certainly offers opportunities that can generate market-beating returns. But why is it then that most retail investors, and quite frankly most professional investors too, are unable to beat the market? Well, I think there are a couple of reasons for this, but in this video I want to focus on one psychological bias in particular that I think makes it incredibly difficult to exploit market meltdowns like the one we are experiencing right now. And so without further ado, let's get started and actually take a look at a little experiment. Alright, hey there, my name is René Salman and I would actually like to start this video with a little experiment. I'll show you a couple of stock charts now, and only based on the chart that you are seeing, you should decide whether you would want to buy the stock here or not. So what about this one here? The chart seems to have a very consistent left bottom corner to right top corner linear shape. Would you buy the stock here or not? What about this one? Over a 5-year period, the stock didn't generate any positive return, but the stock also seems to be down 80% over a period of less than a year. What about this third one? Since its low in November 2020, the stock is up more than 200%. Is this a good buy here? Or what about this last one? Would you buy the stock here or not? Please let me know in the comments down below which of the stocks, 1, 2, 3 or 4, you would buy and which ones you would not want to buy, solely based on the stock charts you can see on screen right now. And if you're curious, I will reveal the underlying businesses of these stocks at the end of today's video. Well, chances are that your decision was influenced by the so-called anchoring effect. And today I want to talk about this anchoring effect or anchoring bias. So maybe first of all, what is the anchoring bias? Well, the psychology textbook definition would be that the anchoring bias is basically a cognitive bias that causes us to rely too heavily on the first piece of information we are given about a topic, which can then have a serious impact on the decision we end up making. Basically, an individual's decision will be influenced by a particular reference point or anchor that, once set, skews our judgment and prevents us from making a rational decision. Let me just give you an everyday example here. For example, in many fashion stores that you visit, an anchor has been put in place to optimize the store's sales. Basically, they put more expensive items at the front of the store. Say you are looking for a handbag and you see a $2,000 Michael Kors handbag in the shop window. When you then enter said Michael Kors store and see a Michael Kors bag for say $300, this bag will seem like a great deal. Basically, the $2,000 handbag was setting an anchor and you used it as a reference point to determine whether the $300 handbag was a good deal or not. If on the other hand, all of the other handbags in the shop were on sale and available for $200 or less, well then the $300 bag wouldn't seem like a great bargain at all. And of course, we can encounter a similar phenomenon in the world of investing, as a big part of investing has something to do with your willingness to pay a specific price per share. And in my view, the anchoring effect influences investors' decision making in two ways. First, the anchoring effect can lead to so-called mistakes of omission. A mistake of omission occurs when you are not investing in a great stock because you never found the time to research the business. Maybe you were unable to build the necessary conviction to actually buy the stock, or maybe because you were affected by the anchoring effect. Let me show you another stock chart here. What you can see here is a stock chart from 2010 to mid-2015. Let's say you have researched the underlying business of this stock chart and determined that it is of above average quality and that you want to own it. However, you decide to wait for some kind of pullback, maybe a 15% price decline, because after all, the stock has never been more expensive than in mid-2015. In fact, just 1 year ago, the stock was available for half the price, for $250. Well, let me show you how the stock has performed ever since mid-2015. The stock no longer trades at $550 a share, but $2,000 a share. That's a compounded annual growth rate of around 22% over a 6.5 year period. So clearly, being anchored to past stock prices of this business. And by the way, the stock chart belongs to the Canadian software company Constellation Software. Well, this would have been a very expensive mistake. Looking back, a very good time to buy Constellation was, of course, in mid-2014. But maybe the second best time was to buy the stock just 1 year later at twice that price. And of course, the same happens after crashes like the one we are seeing right now. Because the best days of the stock market usually happen right after the worst days. To give you another example here, Digital Turbine is a business that helps cell phone carriers to monetize the Android devices they sell. I'm not going to discuss the business itself here, but if we just assume that Digital Turbine is a business that you would like to own and look at the stock chart of that business, well, you can see that the stock is down some 66% from its all-time high. However, just last Friday, the stock jumped almost 15% in just a single day. And believe me, it can be incredibly difficult mentally to buy a stock that was significantly cheaper just 1 day ago. And it's incredibly tempting to just wait until the price maybe declines again to the previous level, even though there is actually no rational reason why the stock would drop to that level again. Now, secondly, the anchoring effect not only leads to mistakes of omission, but also mistakes of commission. These are mistakes we make when we take an action, but our decision actually leads to a bad result. So buying a stock that leads to a loss of money, for example, is a mistake of commission. Simply be aware that looking at new low lists, like 52-week low lists, is anchoring buyers at work. And we're seeing quite a lot of new 52-week lows right now. But just because a stock's price has dropped significantly, this doesn't mean that the stock itself is cheap in an absolute sense. I would argue that for most investors, a 52-week high or low list does more harm than good, because implicitly the 52-week low might be used as a reference point for qualifying whether a business is cheap, and the 52-week high to determine whether the stock is expensive. But that reference point is actually in several ways quite meaningless. A previous price itself has no valuable information at all. Much more valuable is actually knowing the true value of an asset or a business and being aware of the potential gap between the actual intrinsic value of that business and the price it is trading for on the stock market right now. Okay, and now as promised, here are the underlying businesses of the stock charts that I showed you at the beginning of the video. And if you want to learn more about how exactly retail investors can best beat the market and want to get a tip from Bill Miller himself, make sure to watch the following video next. Take care.